The global economy is in a situation where we've been through so much and people have been looking for the next disaster around the corner. So depending on the market, I would say that there's probably more upside than downside just because people have been so scared.
Many assets in today's environment, we talk about distorted interest rates, that many assets are not at equilibrium. When you're not at equilibrium, you have to follow monetary policy or have to follow specific movements in terms of what will drive those risks. So that's something that I think there's going to be a back and forth around for a period of time.
I do think that all of the QE that the various monetary institutions have been undertaking over the last few years has left the world with few tools to tackle a coordinated recession should one come along as a result of either a systemic or an idiosyncratic act.
We're in a world that is awash with savings and not enough demand, and that's a fundamental challenge. I think that it goes beyond national boundaries. I think that it's actually a global issue. And the way that we resolve that has to be through rebalancing from those surplus countries that they demand commensurate with their consumption, but there's a lot of resistance to doing that.
We have clearly seen evidence of greater integration between bond markets globally. Both anecdotally as well as more systematic work has shown that unlike what was the situation in the past, bond markets in the US now respond to bond markets in Europe. And that was one of the prevailing explanations of why bond yields were so low earlier this year in the US.
When conviction is low and people aren't generating return, liquidity is tougher around that. So it's something that I don't think is going away, and I think you have to think about your portfolios in a way, maintain more liquidity within your portfolio, maintain higher levels of cash within your portfolio, and also think about your expressions and what your entry and your exit point is. Think about how diversified your portfolio is. Think about, do you have balance in your portfolio around those dynamics that create a positive environment, even if liquidity dries up for a period of time.
I am not as concerned as some others are about a wholesale outflow of liquidity of the type that we already saw in 2008, where every single fixed income asset class lost liquidity. I am more concerned about an episode of liquidity loss of the type that we had in, for example, energy high yield last year. And these types of episodes, I believe, will be quite common going forward.
We were surprised by the weakness of oil last year. We were surprised by the weakness of oil again this year, and in both cases it has generated significant concerns about the global economy and a significant spike in volatility.
So I think currencies are something to be very thoughtful about going forward. You're looking at many countries around the world that are trying to export their way out of slow growth, and they're using initiatives and they're using monetary policy aggressively, quite frankly, to deteriorate what is the fiat currency. And I think you have to be careful about the volatility is attached to the currency market. We go back and you think about the last couple of years, you've had tremendous reserve build in the world, you've had tremendous dollars that have been sent through the system that have allowed countries to borrow and companies to borrow, and you're seeing a very changing dynamic today where volatility in the currency space we think is going to be significant. It could be significant going forward, and it's one of the tools that you have to manage or potentially take advantage of to try and generate return.